Okay, class, here's part two of chapter 10. And the first part of chapter 10 went into performance evaluation, and that's where we looked at the idea of responsibility centers and how we would perform these lower and middle level managers in these different segments. And we had different types of cost centers. We had cost centers, revenue centers, we had profit centers, and investment centers. And then, of course, the investment centers had some additional ways of doing the performance valuation, including ROIs, return on investment, and residual income. Now, in the process of having these different performance evaluations, sometimes we buy and sell our components between different divisions within a company. And that creates this issue of transfer pricing. In other words, what do we charge between the two different divisions? Because, we're still trying to have the highest ROI, we're trying to have the best operating income possible. And so when we're going to buy between our own company, we want to know what to charge. So transfer pricing is the price charged for the internal sale of products between two different divisions. Okay, so obviously it becomes sales revenue for one of the divisions, and it becomes the cost of buying something for the other division. And it does affect income, ROI, sales margin, residual income, all of those factors that went into the performance evaluation. So we're trying to, again, optimize the overall profitability by encouraging a transfer price only if the company would benefit from the exchange. In other words, perhaps it's better if we simply buy it from an outside company. So when we take a look at this, we must first of all say that the selling division, in other words, who's going to buy it, they want to have the highest price possible so that they can maximize their revenue. And the buying division, they want the lowest price possible so they also can minimize their costs and have higher income. So this question of what do we charge as a transfer price? And it comes down to optimizing the overall profitability by encouraging the price that'll best fit it. Now, vertical integration is the purchasing from other companies within one supply chain to maximize profits. So you might have a car company that also owns, let's say, a tire company. So your vertical integration is you might want to buy tires from, it's a different company, but it's within the overall organization. So how do you determine this transfer pricing? And I'm sorry about the dark red, it just kind of came up that way. So there's three possibilities. The first possibility, use the market price. So let's say the market price, if you go out there and you're going to buy it from somebody else, would be $20. Okay, so you simply would use that as your transfer pricing. And if that's viewed by both parties as being fair, that would be fine. The disadvantage is can only be used if an outside market exists. So you may not have a market for that particular product or part that you want. So the market price could reduce by the cost of saving. So you could even say, well, you're going to save a couple dollars. So let's use the market price, reduce it by $2 worth of savings, and now we'll make the transfer price $18. Now, typically speaking, I would say the majority of the time you use what's called the negotiated price. And this is something that the managers are going to negotiate. Now, it will take some extra time, and it does have some extra effort. It may cause some friction between the division managers, but the price negotiated is typical between the variable cost, which is the lowest of all costs, and the market price. So let's say the market price is $20 and the variable cost is $12, so the $12 variable cost. So negotiation might be, well, we'll make the transfer price $16. Okay, the third way of doing this would be if you use the cost or the cost plus markup. And this is useful if a market price is not available. Okay, so selling division has no incentive to control the cost. So a fair markup might be difficult to determine. So again, you have to have a reasonable negotiation. And this is typically ranging from the variable cost, which we termed as $12, and the absorption cost, which we know that's GAAP, that includes the fixed amount. So let's say that that's $15. And so typically speaking, you can use cost as anywhere from $12 to $15. So let's say that we use this as a $14 transfer price. So the three methods of determining the transfer price, market price, negotiated price, or the cost plus price, and you could come up with something, and hopefully that it is amiable between the division managers. All right, now the last part of this chapter has to do with something called the flexible budget. Okay, and the reason we want to do flexible budgets is a budget prepared for a different level of volume than the original one anticipated. So if your master budget says that you're going to sell 50,000 units and your whole budget's based on that, but you end up selling 40,000, you can see that that's not going to be a very good estimate or a good way to evaluate performance. So you need to make a flexible budget, which makes it an apples to apples type of evaluation. In other words, 40,000 versus 40,000. So performance evaluation purposes at the end of the period. So we'll start by looking at, well, what happens if we use a master budget variance, the difference between the actual and the budgeted or the planning, which that is an apples to oranges. It's not a very good way of doing it, but you have to begin by just looking to see what that looks like. So this would have been the actual results. This is the master budget. So we budgeted to sell 30,000 cases of these tortillas. We ended up selling 32,370. So all of our master budget numbers are based on the idea of selling 30,000. But the fact that we sold 32,370 means our revenues will be higher and our costs will also be higher. So you can see that causes a favorable revenue, but all of these costs are basically unfavorable. And you can have a few of these fixed costs that are favorable, or you can see that they were zero. But you get the idea. In other words, when you look through this, it's not really comparing apples to apples. So you're going to include in here a flexible budget variance, and then we're going to have a volume variance. This one will be strictly because of the difference in volume, and this will be comparing the actual price that we received for them and the price that we paid for them. And that's why this is a much more accurate way. By the way, all of chapter 11 will come from the flexible budget variance. So first of all, what is this volume variance? Well, the difference between the master budget and the flexible budget is only because of the volume, okay? So if you look at this, the volume variance all has to do with the difference between the master budget, okay, and the flexible budget. So again, it's not comparing apples to apples, but it gives you a little bit different perspective. This is what is the difference just looking at the volume. Now, the flexible budget variance, which is really what we're keying on, and this is the beginning of the conversation, will highlight the variance due to causes other than volume. In other words, did we get the product at a lower price? Did we have lower selling, or did we spend more on rent or on commissions? So this is really what we're looking for, is this flexible budget variance. And that's because we're matching the actual number of units that we sold, and then the flexible budget relates to what we actually got. So you can see this is much closer because we sold these for a little bit less, but not the huge difference you have just for the volume. And then each one of these variable costs, once again, they can be favorable or unfavorable, and we are comparing the flexible budget to what actually happens, so you can determine maybe the prices went up and down a little bit during this period of time, but it's much more accurate in determining how well the manager did in controlling costs, or in the case of selling, how much better he did in making sales. If you want to know where does the master budget come from, it comes from a combination of the volume variance and the flexible. Here's the flexible, here's the volume. So if I go back, you look, the volume variance plus the flexible variance gives you the total of the two. Same goes for if you look at the sales commission or the shipping expenses. You're just combining the volume variance and the flexible budget variance, and that gives you the master budget variance. And this is just going to help you answer questions. Really, the one we're going to look at closely in Chapter 11 is this flexible budget variance. But at least you know there's three different types of variances: the master budget variance, the volume variance, the flexible budget variance. Okay, as we mentioned, we do management by exception. That means that we only report on the ones that are affected company finances. In other words, there's either an extreme unfavorable or an extreme favorable amount. Manufacturing cost variances receive a great deal of attention because you're really, in managerial accounting, if you remember from the first chapters, are primarily interested in bringing down the costs. Now, we can use something called the balanced scorecard. And the new balanced scorecard that we use, manager considers both financial performances and operational performances. In other words, financial being the profitability of the company, operational is how well did you actually efficiently use the operations of the business. And this represents a major shift in corporate performance. Financial indicators are no longer the sole measure. In other words, they just used to look at what the bottom line was, and now they're looking closely at other factors. And the other factors are triggered by what are called KPIs, key performance indicators. Okay, summary performance metrics used to assess how well a company is choosing its goals, and they're all reported on this performance scorecard. So here's the four perspectives. Here's the financial perspective, which we've looked at all along. The customer perspective, this is new, very important. How do the customers see us? The internal operations of the business, in other words, the efficiency of the business process itself. And then here's another new one, the learning and growth. In other words, do we continue to improve and create value? In other words, employee training. Are we continuously making our employees better at what their jobs are? When we link the goals, the company goals, to the KPIs, and notice these match up with those four different perspectives of the balanced scorecard. And So now we're going to take a look and say, okay, customer satisfaction. What would be a key performance indicator? Well, market share. That would indicate exactly if the customers are satisfied, there's be a higher market share. Operational efficiency, you can take a look at the yield rate. Employee excellence, how many training hours are the employees getting? And financial profitability, one of the main ones there would be the revenue growth. Okay, so just some details that go into this balanced scorecard. It's not really something that you do a lot of calculations for, but conceptually, it's good to understand. The financial perspective, if we're looking at these four perspectives a little closer, financial perspectives, how can we increase revenue? How can we better control costs? And of course, how can we use our assets more efficiently? That came from, if you remember, when we did the first part of this chapter. Customer perspective, okay, we're looking at the price that the dealerships are offering, the quality ratings, the sales service. When we talk to salespeople, do they really understand their product and how well can they explain it to you? I recently bought a new refrigerator and I was amazed at how much they told me about the new types of refrigerators. And delivery time. People want to buy things and receive them right away. Internal business. Innovation is a huge thing, especially with the new technology. Operations. Is it efficient as possible? And after you sell something, the customers need to be happy with the things like the post-sale service, them getting back to you and making sure that everything worked out the way you wanted. The last one is the learning and growth perspective. Okay. Trying to retain skilled employees is a huge part of having a successful business. Do we need to update our information systems? We are constantly updating information systems, at least at the college. And employee morale is really important also. In other words, is this a climate where people really enjoy? I know my son went to work at Intuit for a while. He loved it. They had a center for just going and relaxing. They got to write down their ideas. They'd go to work in your shorts and your tennis shoes. It was just a super way for people to be innovative in the way that they did their work. Okay, class, that's it for chapter 10. Talk to you soon in chapter 11.